Welcome to HouseLux Estate, your hub for all things related to finance and investment. Today, we're going to embark on an intriguing journey to uncover the secret of identifying undervalued stocks for long-term gains. Now, you might be wondering, what exactly are undervalued stocks? Well, in simple terms, these are stocks that are selling for less than their true worth. Yes, you heard it right. Just like that antique piece at a garage sale waiting to be discovered, these stocks are hidden gems in the vast landscape of the stock market. Finding these undervalued stocks is like striking gold for investors. It allows them to buy valuable stocks at a bargain price and hold on to them for long-term gains. Imagine being able to buy $1 worth for just 50 cents. Sounds exciting, doesn't it? Stay tuned as we delve into the process of identifying these hidden gems in the stock market. Before we dive into the process, it's crucial to understand the basics. So, what is the stock market? In the simplest terms, the stock market is a marketplace where buyers and sellers trade shares of public companies. Each share represents a tiny ownership stake in that company. When you buy a share, you're essentially buying a slice of that company's future profits. Now, how do you determine the value of a company? That's where company valuation comes in. It's a financial process that calculates the worth of a business using several techniques, such as analyzing its financial statements, assessing its management, and comparing it with similar companies. The key is to remember that the price of a share doesn't always reflect the true value of a company. Sometimes the market may undervalue a company due to various reasons, such as temporary setbacks, market volatility, or simply lack of investor awareness. These are the golden opportunities that long-term investors seek, buying shares of a good company at a bargain price and then enjoying the profits as the market eventually recognizes its true value. But here's the catch. Identifying undervalued stocks is not as easy as it sounds. It involves a lot of research, analysis, and, most importantly, patience. You need to dig deep into a company's financial health, understand its market position, and evaluate its stock price in relation to its intrinsic value. Plus, you need to keep an eye on the overall economic environment, industry trends, and potential risks. Remember, investing is not about following the herd and jumping on the hottest trends. It's about making informed decisions based on solid research and sound judgment. It's about finding hidden gems that the market has overlooked. And that's why it's so important to understand the basics of the stock market and company valuation. Because once you do, you'll be better equipped to identify those undervalued stocks and make smart investment decisions that can potentially yield significant long-term gains. Now that we have a basic understanding, let's move on to the steps of identifying undervalued stocks. The first step in identifying undervalued stocks is analyzing the financial health of a company. At the heart of every sound investment decision lies a meticulous analysis of a company's financial health. This analysis is conducted through a careful examination of financial statements, balance sheets, and cash flow. These documents provide a clear snapshot of a company's financial standing and stability, and are indispensable tools for discerning investors. Let's start with financial statements. These documents provide a comprehensive overview of a company's revenues, expenses, profits, and losses over a specific period of time. They provide valuable insights into a company's profitability and its ability to generate positive returns for its shareholders. Next, we delve into the balance sheet. This statement provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It's essential to evaluate a company's debt levels and how they compare to its equity. This brings us to the debt-to-equity ratio, a key metric that indicates the proportion of a company's funding that comes from debt versus equity. A high ratio could be a red flag, indicating excessive debt burden that could potentially hamper future growth. We also need to consider cash flow. A healthy cash flow indicates a company's ability to pay its bills, invest in growth, and return money to shareholders. It's the lifeblood of any business and a key indicator of financial health. Lastly, we scrutinize key metrics such as earnings per share, EPS, and return on equity, ROE. EPS is a measure of a company's profitability on a per-share basis, providing a snapshot of how much profit a company is making for its shareholders. RO, on the other hand, measures how efficiently a company is using its equity to generate profit. A company with a high ROE is likely to be more efficient at generating returns. Remember, numbers don't lie. If a company's financials are robust and it's generating healthy profits, it's likely to be a solid investment. A thorough financial analysis is the foundation of identifying undervalued stocks. The next step is assessing the company's market position. A company's market position is like a map that shows where it stands in the competitive landscape. It uncovers the company's strengths and weaknesses, its market share, and the growth potential within its industry. It's a snapshot of a company's competitive advantage or disadvantage compared to its rivals. Imagine you're in a race. Wouldn't you want to know where you stand compared to your competitors? Are you ahead or are you trailing behind? It's the same with investing. You wouldn't want to put your money in a company that's lagging behind its competitors without a clear strategy to catch up, would you? Now, let's discuss the 3 elements we should focus on: competitive advantage, market share, and industry growth. Firstly, competitive advantage. This is what sets a company apart from its competitors. It could be a unique product, a strong brand, cost efficiency, or superior customer service. A company with a competitive advantage has a better chance of surviving and thriving in the market. Next is market share. This measures the percentage of an industry's total sales that's earned by a particular company over a specific time period. A company with a high market share is likely to be more stable because it's less susceptible to the competitive pressures that smaller players have to face. Lastly, we have industry growth. This reflects the overall health of the industry in which the company operates. High industry growth means there's an increasing demand for the company's products or services, while low growth indicates a saturated or declining market. A tool that can help us in assessing these elements is the SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. It provides an in-depth look at a company's internal and external factors, helping investors make a more informed decision. Understanding a company's market position helps investors predict its future profitability. It's like having a crystal ball that gives you insights into the company's potential for success or failure. So, before you invest, always take the time to assess the company's market position. It's your map to investment success. The final step is evaluating the company's stock price. Now, this is where the rubber meets the road. To determine if a stock is undervalued, we need to calculate its intrinsic value, which is the perceived or calculated value of a company, including tangible and intangible factors, using fundamental analysis. Think of intrinsic value as the actual value of a company, not its current market price or stock price. One way to do this is by using valuation ratios. These are financial metrics that investors use to compare the balance sheet and income statement of a company to its current market price. First, let's talk about the price-earnings ratio, also known as the PE ratio. This measures the price you pay for each dollar of earnings. A lower PE ratio could mean that the stock is undervalued. However, it's crucial to compare the PE ratio of the stock with its competitors and the market average to get a better picture. Next, we have the price-book ratio, or PB ratio. This compares a company's market value to its book value. A lower PB ratio could mean that the stock is undervalued. But remember, some industries naturally have higher PB ratios than others, so always compare within the same industry. Lastly, there's the price-sales ratio, or PS ratio. This compares a company's market capitalization to its revenue. Again, a lower PS ratio could mean the stock is undervalued. But here's the key. These ratios aren't definitive. They're just tools to help you make a more informed decision. It's always important to look at the entire picture, including the company's financial health, its market position, and its future growth prospects. By comparing the intrinsic value with the current stock price, investors can identify potential undervalued stocks. Remember, investing is as much an art as it is a science. So, keep learning, keep analyzing, and most importantly, keep investing. Identifying undervalued stocks is a skill that can lead to significant long-term gains. We've navigated the path together, understanding the basics of stock valuation and delving deep into the 3 crucial steps: analyzing the financial health of a company, assessing its market position, and finally, evaluating the stock price itself. These steps, while simple in theory, require thorough research and informed decision-making. Remember, the world of stock investment is not a gamble, but a strategic battlefield. Your weapons are your knowledge, patience, and a keen eye for details. As we've learned, the key to identifying undervalued stocks lies within the financials, the market position, and the stock price. But the real secret, the magic ingredient, is you. Your dedication, your diligence, your drive to succeed. Thank you for joining us at House Lux Estate. Don't forget to subscribe for more investment insights. Until next time, keep investing wisely.